Hi guys, welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka. Well, what a Friday it has been for the market. In fact, what a week it has been for the market. A washout week, so to say. We've seen the Nifty, in fact, the entire market cracking for a sixth straight session. That's its worst week in 7 months. We're poised to be clocking the worst week in 7 months for the market. For the week, we've seen the Nifty shed almost 3%. Just want to point out that from 1st to 18th. September, we had rallied somewhere around 950, 960 odd points on the Nifty. But in the last 7 sessions or 8 sessions or so, we have, given up almost 70, 80% of those gains. We've lost over 750 points on the Nifty in a matter of 8 sessions. So that's the kind of sell-off we have seen. One would have already taken heart from the fact that September, which is usually a weak month for equities, was proving to be a good one. But all of that sentiment has been reversed. 6 straight day of losses. We've entered that zone where one doesn't really know, whether the markets will stage a recovery or are we going to test those August lows once again. But let's see how things really pan out in terms of the action today. Of course, no points for guessing is the pharma pack that's hogging the limelight. Of course, after Trump has imposed 100% tariff on specialty or patented drugs. The innovator drugs, so to say. He's left out generics for now, but the big question is whether generics will also be tariffed going forward. We'll be getting you a guest on the show to answer all those questions, but quickly take a look at the broader markets. The Nifty Mid Cap Index has plunged over 1100 points, 2% cut on the Nifty Mid Cap Index. The breadth of the market is extremely poor, grossly underperforming benchmarks. The NSE Advanced Decline ratio today is 1:6. That's the kind of pain that's there in the broader market, extremely weak. In fact, volatility is also high. India VIX has jumped almost 7% or so. And, we were already pretty gloomy. We started the festive season also on a gloomy note, but this tariff news has further clouded sentiment, and which is why we are seeing an almost 250-point cut on the index. But without any delay, let me bring on board our guest for today. Joining me is Aditya Khemka, CIO Incred Asset Management. Aditya, lovely to be chatting with you. We'll come to the pharma index in just a bit. I was saying that September was, otherwise turning out to be a very good month for the market. We were seeing a bout of recovery. The GST rejig, the new rates kicked in earlier this week, and everybody was pretty happy on the domestic front. What are you making of how the sentiment is panning out now? In the last 6, 7, 8 sessions, we've seen the Nifty give up a sizable amount of gain as well. And US-India relations, in the middle there were, some hopes, or there was a lot of camaraderie. But post that, the Russian oil rhetoric continues, and we've now seen this tariff. There have been a lot of talks on both sides, but where do you think the market's heading? And how do you see this India-US trade ties emerging going forward?
So, good afternoon and thanks for having me, Nandita. So, as far as the markets go, I think it's a sticky wicket that the markets are on. If you look at the historical PE multiple of Nifty 50, the historical average comes to 18, 19 times, and the historical earning growth is between 13 and 14%. So, from a PEG ratio standpoint, the average PEG ratio historically has been around 1.5. Now, if you look at the current valuation of Nifty 50, the P multiple is close to 22. The earning growth is around 10%. So the PEG ratio comes to around 2.2, which is, let's say, about 40-50% higher than historical averages. So is there an excess in the system? There is clearly an excess in the system. And I guess what we are seeing over the past 4, 5 sessions is that excess is kind of reversing a little. And which I wouldn't say was out of something that we were expecting. I think we were expecting a correction somewhat. And, majority of our portfolios at Incred, we have some cash holdings because we believe these corrections should be bought into given the long-term trajectory of our economy and the long-term trajectory of the Indian corporate looks very, very rosy. So definitely in the sort of ballpark as far as our expectations go. Coming to the India-US ties, I think, it's an environment where each of these countries are thinking for their own. Whatever policies they feel benefit them the most, they will basically act on it. A collaborative effort has reduced significantly, and inward-looking is kind of the rule of the day today. So from that standpoint, I'm
Hmm.
not surprised with these U-turns and sudden camaraderies and then sudden tariff attacks. I think that's sort of it's the stick and carrot approach, which is a age-old approach to take. And I think this will continue till the time the administrations come on a deal, a trade deal, where they settle the
Hmm.
terms on which they will engage in mutual trade, and those terms have to be mutually beneficial.
Hmm. Got your point. Of course, this latest tariff attack. I want to understand your view on Indian pharma now. This was always coming because he had already stated that never seen before tariff will be coming on the pharma pack. But of course, there were concerns, their inward concerns of drug shortages if generics were brought under the fold. That hasn't happened yet. But in terms of innovator drugs, patented drugs, 100% tariff. We know that Sun Pharma, Biocon, Wockhardt, these are some of the players that get impacted. But which of these stocks do you think will get the most impacted? And how would you look at the entire pharma basket after this?
So look, I'll answer your first question first. So let's say the three companies you mentioned, Sun, Wockhardt, and maybe even a Biocon. Um, from a impact standpoint, if you are looking at a EPS impact standpoint, the impact might be most pronounced for a Biocon and then maybe a Sun. And I see a lot of maybes here because the regulation isn't clear what it includes, what it doesn't include. So
Hmm.
let's say you export 20 products from India to US, but you manufacture two products in US. Does that qualify you for a tariff? Does not qualify you for a tariff? None of these fine prints are available or clear. So there's a lot of just there's a lot of guesses that we're taking at this point. But if I had to take a guess, I would say that biosimilars would come under the ambit as they are considered branded drugs in the US. And if they come under the ambit, then Biocon will probably be most impacted from an EPS standpoint. The second most impacted, I believe, could be
Hmm.
Sun, because they do manufacture the specialties, products outside the US and then sell into the US. So there might be some tariffs there, although these products may end up getting manufactured outside India, but they're not manufactured in US by Sun. So there might be
Hmm.
some impact coming from that. Um, Wockhardt currently doesn't have any revenue coming from the US, but they do have a product in pipeline, WCK 5222, which forms a very large part of the earning expectations that people have from Wockhardt over the next 2, 3, 4 years. And hence, if
Hmm.
WCK 5222 isn't manufactured in US, isn't given out on contract basis to a local US manufacturer, then you would again have some challenges in terms of their ability to commercialize the molecule successfully or on a large scale. And that is where, even a Wockhardt might have a potential impact.
Hmm. But for Biocon, they have recently commissioned a facility there. What kind of a fine print or what kind of an update would you be looking forward to when it comes to companies that already have manufacturing units there?
Yeah, so look, you can have manufacturing unit there, but let's say you're manufacturing drugs A,
Hmm.
B, and C in that manufacturing unit. And
Hmm.
then you have, let's say, another bunch of 20 drugs that you're manufacturing in India and selling to US, right? So now, if I just
Hmm.
take the regulation at its face value, that would imply that the three drugs that you manufacture in the US facility should not get tariffed, and the other 20 drugs that you're selling from India to the US should get tariffed. But that's not how the regulation has been worded. The regulation says that if you have broken
Hmm.
ground or if you have a facility in the US, then you should not be tariffed. So, it's very unclear. The fine prints are not available and we just don't know how this works. Which is why, more details
Hmm.
are needed before we can make a more accurate guess on, how things might pan out for these companies.
Hmm. One more question then. In terms of generics, very quickly, your thoughts on whether generics would be brought under the fold, because that would lead to drug shortages in US itself, right? Because of that, do you think they will be exempted? And should generics really heave a sigh of relief, saying that yes, now we have clarity as to what kind of tariffs were slapped within the pharma pack, so we are exempt. Should that be the sentiment right now, or should there be fear that we'll be up next for tariffs?
It's hard to guess, Nandita, how the Trump administration would think about generics. What I can say is that at this point, generics, obviously, as we know, are exempt. What I can also say is that as a fund manager, as a CIO, when we look at stocks like these, companies which are heavy generics selling into the US, um, we feel that the risk of a tariff is there, right? The risk might be 5%, 10%. 80%. I don't know. But the risk of the tariff exists. And the fact that the risk exists makes me question their earning trajectory. And the fact that the risk exists make me also question the valuations at which these scripts are trading at today. And hence, as a fund manager or as a portfolio manager, I would rather not have that risk in my portfolio. And I would rather focus on companies that are not exposed to this risk at all and are maybe available at similar or lower valuations than these companies.
Sure. Any impact on CDMO players, Aditya?
Yeah, again, in the absence of finer print, just as a disclaimer, these are initial thoughts. If finer prints emerge, we can have more clarity on these thoughts. But on the face of it, it appears that the regulation is targeting final end product. Uh, See, the pharma value chain globally is very, very integrated. It's very, complicated as well. You might have products where, the raw material is coming from China, the API is being made in Europe, the intermediate from the API is made in US, and then the final product is manufactured in India and then exported to the US. Now, if you start tariffing even the intermediates or the APIs, and then you tariff the final product as well, then you can have a situation where you'll have multiple tariffs applied on the same end product. So a simple way out of this conundrum is to just tariff the end product and not the intermediate and the API level. So because again, we don't have clarity on these things, we do not know if CDMO players will be exposed to this. But the probability on the CDMO side can be much, much lower because they are intermediate suppliers. And because of multiple tariffing being a significant challenge, I would believe that the administration may want to, if they at all tariff generic products, they may want to tariff the end product other than the intermediates.
All right, got your point. But Aditya, you said that you guys have some cash on books. So where would you be deploying money now? Because pharma, you've already mentioned that you would not want to have that risk in your portfolio. IT, we saw, what happened with the H-1B visa curbs, because IT sentiment is very weak. Although, most analysts I've spoken to have said that there will be limited margin impact, and things will evolve. Top lines will be protected, given the fact that part of it will be passed on to customers, and things are not looking all that bad. It's not all that gloom. That's what some analysts have said. But in terms of deploying cash, would you look more inward and look at domestic themes, for example, autos?
So we manage multiple portfolios, Nandita, here at InCred. So one of the portfolios we manage is a healthcare dedicated portfolio. In that portfolio, we would definitely look inwards. We will look to buying branded generic companies that sell mostly in India. We would look to buy hospitals, diagnostics, which are services organizations, again, selling in India. So that's a very clear cut, when we're looking to deploy cash. On our multi-cap and small and mid-cap portfolios, we are looking to look at maybe autos, maybe cement, maybe FMCG, again, more inward-looking businesses versus outward-looking businesses.
All right, more inward-looking businesses. And any thoughts, any views on where we may head by year end? Because as I mentioned, things were looking a little better for us, especially after the S&P upgrade as well. And we have the rate easing cycle ongoing. We have the RBI policy next week, although the street is divided whether or not we'll see a rate cut this time around or not. But given all the tailwinds, would you still expect better returns for the year? We just have about 3 months left, 3.5 months left for the year to end. So any thoughts about where we would be ending the year around?
Yeah. So look, it's very difficult to guess market levels at such a short-term time frame. As I said, it's amply clear to us that markets have been in the overpriced zone for a while now, where the PEG ratio has been around 2 to 2.2, whereas the historical PEG ratio is around 1.5. So we definitely expect the markets to stay kind of sideways for some more period, or earnings to catch up very, very quickly. Now, if you ask me, I don't see an earning catch up happening given what's happening in the broader economy. So the markets may show you some more absolute downside or more prolonged time correction, which tends to be more painful actually for many of the investors. So that's where I would suggest markets may remain. And yeah, as again fund managers, we'll just wait for the earnings to catch up or the market to show us some absolute price correction before we deploy more.
All right. Okay, got your point. With that, Aditya, I would let you go. I wish we had more time. I have many questions left, but next time then. But thanks a lot for taking out time and joining in and sharing your thoughts. Always appreciate chatting with you.
Thanks, Nandita. Same here.
Thank you. Well, that was Aditya Khemka of InCred Asset.